technology has improved so much. Now I can literally look at a database of over 92,000 items and build out an entire property within, a couple of days, working with an AI tool that can now read the blueprints and then plug in the data. It's going to allow us to do a lot more work. And I think it's going to make it a lot more affordable across the, just the industry. So I think what it's going to do is we're going to see a lot more work.
Welcome to the Path to Passive podcast, where we talk about building wealth and empowering lifestyle through commercial real estate investing for tech professionals. I always wish that other tech professionals reaching financial freedom had documented their journey along the way, so I'm doing it for the rest of us. Join us as we explore stories, many failures, and lessons learned along the way. I hope you enjoy and subscribe. Brian Kiczula has been helping real estate investors navigate the changing real estate markets since 2002, active member of the American Society of Cost Segregation Professionals and founder of Cost Seg Rx. Cost Seg Rx or Cost Seg Prescription? How would you say that, Brian?
Just Cost Seg Rx.
Awesome, dude. Well, I'm super stoked to have you here. As I was talking about before we started recording, I have a lot of people, a lot of investors come to me and asking me about what they should invest in. And it usually starts that conversation with, what are you doing today? Where would you like to go? And we start even talking about something like commercial real estate or anything like that. And it's a brand new realm. And when I think of things, some of the foundational things that investors need to know about, Cost Seg is one of those things. So I'm super stoked to have you. Tell me a little about your background. How did you get to the place you're at right now? I'm always curious about people's stories and how they arrived to something just like this.
Yeah, I was going to say, nobody grows up thinking they're going to be a cost segregation specialist. That's for sure. And I'll tell you, my wife still doesn't really know what I do. Yeah, backgrounds in real estate and mortgages, got in way back in 2002. And fast forward to 2019, I had some health issues pop up. I had to step away from work for about a year and kind of scratch my head and figure out how I was going to reinvent myself. And, I'd been analyzing tax returns for, better part of 20 years. So I figured I would, start doing tax returns, tax preparation, just because it's something that interested me. But once I started doing the work, I realized that it just wasn't something that I really wanted to do full time.
Mm-hmm.
And I just kind of stumbled into cost segregation. And now I literally focus on just that one page of the tax returns. And that's where I, really add value to real estate investors, CPAs. And it's just a great niche for me to be in.
Super cool. So I know some might be hearing this and you're like, all right, cool. We're both excited about this. You're excited about obviously finding your way into this niche, but what does Cost Seg actually do for the investor, or how does it get to that investor? Why should the listener really care about it?
Yeah, so it's the why. Why do you care about cost segregation? And really, it's the depreciation that we're able to provide on your real estate investments, whether you're buying a single family home or a car wash. Those assets are going to be depreciable. And the standard way to depreciate the asset is to take it over, let's say, 27 and a half years or 39 years, and you're offsetting either active or passive income with the depreciation that asset generates. So the why is to save on taxes.
So break that down just a little bit more, because I talked to a wide variety of people at different levels with their understanding. We've heard of depreciation before, but can you just spend a little bit of time talking about that aspect, and then we can relate that further and go along to
Yeah, absolutely. So when you're looking at you're buying a piece of property, and we'll just call it a single family residence to keep it simple.
Mhm.
So you buy a single family residence for, let's say, $400,000. The first thing that you have to do is you're going to have to carve out a land allocation, and the IRS is looking for a reasonable land allocation. And the reason why you have to carve it out is because it's a non-depreciable asset. So that would give you, let's say, $300,000 of a depreciable basis that you can depreciate on that property over 27 and a half years. So you can do straight line depreciation, and a lot of real estate investors do. But you're really missing out on, the short lives that some of the assets have. Think about your appliances, or think about swimming pools, and different things like that that you can accelerate. So yeah, so it's basically using that depreciation to offset either active or passive income.
Awesome. And
Yeah.
so one of the ways, and let me know how on base I am with this one. And so one of the ways I've always kind of interpreted and understood it is that the depreciation is these different assets, right? Can actually they have those different lifespans, which you'll inform us all about.
Hmm.
But they all age at different times and different. And like you were talking about with the appliances or with the structure and stuff like that. And so this is something that the IRS allows us to do, right?
Correct. Yeah. I mean, you can, read if you're looking to fall asleep early, IRS publication 946, and read all about how to depreciate property, and look at the maker's depreciation tables in the back. And yeah, so absolutely, you're able to depreciate different assets over different time periods. And I'll tell you, a lot of clients,
Mm.
I'm talking to a client yesterday that didn't even know he was supposed to depreciate his real estate. So he acquired a property back in 2016, never took any depreciation on it. And he was talking to his CPA, and CPA called him out on him. He's like, look, you're going to get hit with depreciation recapture on that property, whether you took it or not, because the IRS is assuming you took the depreciation on it. So we just, we did the cost segregation study for him. He's going to file the form 3115 and pull forward, about $100,000 of missed depreciation on that one property, because he never took it in prior years. So we're able to catch him up on it. So that was
Nice.
a big eye opener for him. And I see it all the time. The thing is too, when I'm reviewing these fixed asset schedules for clients, often, it's like before you file, or before you file your tax returns for that first year when you acquire that property, really double check your CPA's work, because I just said a second ago that land allocations, or land is a non-depreciable asset.
Hmm.
I've seen CPAs assign upwards of 90% of the purchase price to the land, because that's what the county tax record says. And I'll tell you,
Mm.
you go buy a $2 million home in LA, and they assign 90% of that to the land. You just,
You can't depreciate it.
yeah, yeah, it was a big error. And, we can fix those types of errors,
Hmm.
but it's better to catch them on the front end,
Yeah.
for sure.
That makes sense. You want to put more of that value on the structure, on everything else above the land, because a non-appreciation asset is something that won't depreciate. Like there's going to be wear and tear, but the IRS doesn't care about that. It's the structure and everything else above, right?
Yeah, I mean, your land is just, it's just non-depreciable. So I would say, you want to assign a reasonable land allocation. And that's a big topic, because, how do you come up with the land allocation?
Hmm.
Well, there's, six methods that I'd look at, to figure it out. But I'm certainly happy to answer any other questions that you have before I
Yeah.
jump into that.
So someone goes to buy a property. Let's put this in kind of a store form example. Someone goes to buy a property. They buy this. Let's say they own their own residence already, or they have some place. They're going to buy an investment property, right? And this becomes one where they're like, okay, cool. This is a single family home, and you're talking about here that on the acquisition, or once they buy it, we want to make sure that there's most of that value that's assigned to, how would you call it, the structure or just property itself, that and anything that is not the land, right?
Yeah, so you're gonna, when you do a cost segregation study, we'll break it up into the different components. Traditionally, if a CPA looks at it, or you do it yourself, you're gonna purchase that property again for $400,000,
Hmm.
assign $100,000 to the land if that's reasonable for the area, just,
Okay.
and then you'll have that $300,000. So then what we do on the cost segregation study is we're going to take that $300,000, and we're going to go look at the property
Hmm.
and further allocate it, so you're not assigning it all to the building itself. So when I'm talking to a client, or even doing an estimated benefit, that's really the first place to start, is to get an estimate.
Hmm.
I'm going to look at the exterior of the building. What's outside of the footprint of the building. So think your landscaping, your sidewalks, your driveways, tennis courts, um, anything that's not part of the structure itself, that's going to be a site improvement for the most part. So a 15-year asset. So, and bonus eligible. I mean, fingers crossed, bonus depreciation bumps back up to 100% this year. So you could take 100% of all those assets in the first year. So then we'll go into the interior of the property and look at your interior improvements. So think about your removable flooring covers, think about appliances, and depending on the different assets, some of them will have, just whatever is unusual for the structure that doesn't have to do with, let's say, the maintenance and operation of a building. We'll take those items and we'll accelerate them as 5-year assets.
Hmm.
So think, we'll pull forward all of those items. And again, 100% bonus depreciation. So you're pulling forward all of that. So then it's, why would you use it? I don't need that much depreciation. Um, and the reason why you wouldn't need it is because, let's say, it's strictly a passive source of income. You're not a full-time real estate investor. You're not qualifying for, let's say, a short-term rental loophole or another active type of business. So you're only able to offset passive income. Well, it's not a use it or lose it scenario. So you're able to take all that depreciation that you're accelerating and have it sit on your fixed asset schedule until you need to use it. So, I would recommend, whether you're an active real estate investor or passive, or I should say whether you're generating active income or passive income,
Hmm.
it's worth taking a look at the benefits and reviewing them with your tax preparer. Yeah.
Cool. So really, like you were saying, it's not just property, but you call it site improvements or site footprint, right?
Sure. Yeah.
And all of these different assets can be depreciated at different schedules. And so with that, there's some that you would pull forward. Now, a question that I had when I was first starting to learn about this is how 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 does that make sense? Like, how does the we'll call it the IRS allow us to do that? I know this can be a huge topic, but just can you give just talk about that briefly about why do they let us do this?
Yeah, I mean, why does the IRS allow you to depreciate a building over 27 and a half years if it's residential? Why does the IRS allow you to depreciate a building that's commercial over 39 years? Well, they just, I mean, they calculated it, they came up with it. It's changed over the years,
Hmm.
but that's the current system that we're in. When it comes to short life assets, there's certainly been court cases, um, just a number of, let's say, guidance that we follow when we're doing cost segregation studies. And the reason why they're doing it is because over time, the economic use of a lot of assets in the property are really just deteriorating. So they're allowing you to offset uh, the physical and functional depreciation on those assets over periods of time. And that's it. Think about your roof covering.
Totally.
So I just had to replace my roof. They're not cheap, and they last about you know I don't know, let's call it 25 years. Here in Florida, the
Hmm.
insurance companies will stop insuring them after 20 years, so you're forced to replace them. You buy an older home or an older commercial building, you're most likely going to have to replace that roof. So that's why they're allowing you to depreciate these assets. Another big part of cost segregation that clients miss, speaking about the roof is going to be a straight line depreciation item. It's part of the unit of property of the structure. So those items are always going to remain straight line items. So with the roof, let's say that you buy a property, let's say you buy a commercial warehouse, in 5 years into the your ownership, you have to replace that roof. Well, that roof would technically be sitting on your depreciation schedule for another 34 years because you can depreciate it over 39 years. Well, what the IRS will also allow you to do is they'll allow you to take partial asset dispositions. So now you could, if you had a cost segregation study done, you could say, well, it cost me $100,000 to replace the roof on this building. And I had $25,000 allocated on the cost segregation study as the remaining depreciable life. You could take that all in the year that you replace the roof. So partial asset dispositions are an overlooked topic on cost segregation studies for the straight line depreciation items. So I know this stuff gets pretty boring if you're, you're not really, we're talking about depreciation and assets, but this all goes back to the why. And we're right in the middle of tax season. So a lot of your clients are probably writing pretty big checks to the IRS,
Hmm.
and they're probably scratching their heads on how they can offset these taxes or reduce them. And I would say real estate, whether it's single family homes, car washes, gas stations, RV parks, mobile home parks, whatever asset class you're comfortable with can provide a tremendous amount of depreciation. And depending on your role of material participation,
Hmm.
will determine how you can take advantage of it, writing off that taxable income.
Cool. I'm glad you mentioned that, especially the different asset classes, because just like you were talking about, it could be there's, they're all different assets. They're all different, have different depreciation schedules. They're all properties. They have all the site, things on there as well, and the role that the investors are playing in how they've invested. And do you mean that from more of that level of active and passive, like you were talking about previously?
That's correct.
Okay, so
Hmm.
many. So let me tee this up for you then. Um, Most of the investors are all going to be passive because they've invested in syndication or a fund. And
Hmm.
so, let's start with that one first. That scenario. What should they be thinking about in that scenario about getting, capturing, or using any depreciation, or even going and asking questions to their accountants, as an example?
Yeah, so I would recommend again, if you're in a situation where you're a limited partner and you're generating
Mhm.
passive income
Yep.
on these properties, you're still getting a K1 at the end of the year. The K1 is probably going to have a negative number because of the depreciation that the property has provided, and then it will offset other passive income properties that you have. And the benefit there is, let's say you sold an asset, so you sold a property, another property that you owned, and it generated a return, and now that's taxable. If you had passive income sitting on your fixed asset, or the passive depreciation, you had that depreciation just sitting on your tax return, you'd want to talk to your CPA to see if it would offset the other gain that you received on the property that you just sold. So
Cool.
yeah, so it's one of these things that, when I'm talking to clients, I'm usually looping in their financial advisor, their CPA for sure, maybe their attorney.
Mm.
A lot of clients have family offices, so we'll talk to them to make sure that whatever strategy that we're moving forward with really works for their long-term goals. And one of the things that we look for is, if you come to me and say, "Hey, Brian, I want to do a cost segregation study on a property. I'm
Hmm.
planning on selling it next year." I usually put the brakes on and say, "Okay, well, why are you doing this?" Because if you do that cost segregation study, you're going to have depreciation recapture. You're going to have it no matter if you do a cost segregation study or not. But if we accelerate all the short life assets, all of a sudden that depreciation recapture really bumps up. So you need to make sure that you have a plan in place on how you're going to handle that. Are you going to acquire another property? Are you going to do a 1031 exchange? So um, really just bring in your team and have the conversation with them regarding how you're going to apply the findings to your tax returns. So, with your passive investors, it absolutely will help them offset other passive income that they're generating.
Certainly. And so, just following along with this is something that I'll just use the terminology that I'm usually talking with my investors too. It's really something that the operators need to do, right? The people that are managing that asset, they're the ones that will need to bring in a someone to do a cost seg study on the asset itself, just like
Correct.
you're
So I
talking
work
about.
I work with a lot of clients that are, they syndicate deals,
Hmm.
and they'll buy, let's say, a RV park, and they'll do improvements. They'll add, $1 million of improvements to that RV park. So what they'll do is they'll hire me to do the cost segregation study. I'll do the study on their initial acquisition, and then I'll do a capital expenditure study on their improvements. And then, when they're compiling their, final returns, their tax returns, they're applying that, and then they're passing that over to you. So
Flows
all the
through.
yeah, it does.
Cool. How does this scenario apply for that other example I was talking about, where someone just goes to buy a single family home? would use and they were buying, like I said, they own their own residence. They were buying their first investment property. Would they want to do a cost seg study on just a single house as well?
Yeah, I would say definitely. So again, active or passive income, that's going to be the big piece. They're going to want to hold on the property for, minimum 2 to 5 years plus. Um, but they would absolutely, I mean, I would recommend doing a cost segregation study, or at least getting an estimate of benefit to see how it's going to impact them. A lot of times, what clients are doing is they're not buying that investment property. Maybe they live in their property that they own, and then they're buying up and they're renting out their original house. That's how we see a lot of real estate investors get started.
Yep.
You could do a cost segregation study on your existing property. We're just going to use your original basis or the lesser of the current market value. So when we look at applying the basis to the cost segregation study, so I'd say historically cost segregation studies were not popular with tax preparers or investor friendly CPAs, just because the cost associated with doing a cost segregation study was so expensive. But like most things, and your audience is tech
Hmm. Yep.
savvy. It's like technology has improved so much over the years that we can do a cost segregation study, um, super affordable, where, before it used to be thousands of dollars. So the return on investment just wasn't there. But if you can do a study for under $1,000 and have a potential, uh, accelerated depreciation benefit of, let's say, $100,000, and you're at a 37% tax bracket, all of a sudden, that's $37,000 in dollar for dollar savings for something that cost you under $1,000.
Yeah.
So,
Yeah.
so
I
even
mean,
on a single family home, it works.
totally. This is an interesting one I hadn't thought about or know of. You're saying that someone can do a cost seg study on their primary residence and gain benefit.
Only if they convert it to an investment property.
Okay.
Yeah. So if you convert it to, you buy another property and you start renting out your original home,
Hmm.
you're going to place that property into service because you need to start depreciating it. So you might as well do the cost segregation study on it. So that's why, when clients come to me that are, they are doing that strategy, um, I always ask them, well, what improvements have you made to the property over the years? Let's make sure that we have the basis right, because maybe they've added, another $100,000
Sure.
of improvements. I know I have in my property. I've added a swimming pool. I've redone the roof. I've swapped out all the windows. So my original purchase price doesn't reflect what the value of the property
Totally.
actually is. And you can't make it up. You have to actually have the numbers. So
Got to
it's
have
not
receipts.
yeah. So the burden, the real thing with the IRS is, and this is a scary thing. Nobody likes it, but it's the truth, is the burden of proof is on you,
Hmm.
as the taxpayer, because they don't know what you bought the property for. So if you're ever involved in an examination or an audit, then you just need to be able to substantiate what you're saying, just like your W-2s. Well, show me your W-2,
Yep.
show me your closing statement, show me the appraisal, show me your receipts. So that's one of the things that I do is, is I'm asking for these items from clients. And sometimes it seems like a lot of heavy lifting, but it's better to have, everything organized on the front end.
Of
So,
course.
so
Of
just
course.
keep all your, keep that shoebox. And our shoebox today is called Dropbox, or, my
Right.
Google Drive. So it makes it
Yeah.
so much easier.
Yeah. Because the alternative can mean hot water with the IRS, and you don't want that.
Well, it's just kind of scrambling to find stuff. Yeah. So just
Yep.
be organized. Yeah.
So you talked about bonus depreciation a couple different times, and talked about this from the accelerating different parts of the property or the site in general. They're on different schedules. You talked about straight line depreciation, and the other one, the contrast that is accelerated depreciation. That's the comparison in terms, right? Straight line and
Yeah, well, we're
accelerated.
accelerating the depreciation, sure. So
Hmm.
your straight line depreciation, again, residential 27 and a half, commercial 39 years.
Hmm.
But then on your short life assets, you're typically on a declining balance method. So your 5-year assets and your 15-year assets are going to there it's an accelerated depreciation schedule already. You're front loading the depreciation in the early years. The IRS allows you to do that. You just have to follow the maker tables. Most CPA software automatically calculates it for you. But then in addition to that, you can take bonus depreciation. So bonus depreciation allows you to take big chunks of that initial asset up front. Back in 2017, they bumped bonus depreciation up to 100%. In 2022, or really 2023, it started to phase out 20% per year until it phases all the way out. Now, with the current administration, they're looking at bringing it back up to 100%. There's been talk that they're going to make it either permanent or they're going to push it forward for another 5 years. And it looks like if it gets passed, it will get passed retroactively from January 20th, 2025, moving forward. So your clients that acquired property earlier in the year will still be able to take advantage of this on next year's tax returns.
Super cool.
So yeah, it'll be interesting to see if it passes. I think there's support on both sides of the aisle. And the reason why is because it really does stimulate the economy. So let's say you go out and you buy now we'll step away from real estate and we'll talk about other businesses. So,
Mhm.
you're HVAC guy and
Yep.
you buy a truck. So now you just paid $50,000 for your work truck and you can accelerate 100% of that asset into the first year. Well, then this HVAC contractor is more likely to go out and make that purchase to help him offset his taxable income. So, it's powerful, not just for real estate investors, but for all types of businesses. And
Thank
it
you for
really,
mentioning that.
yeah, it does really, it bumps up it benefits the entire economy. So it's not, I hear a lot of, hey, this is only a benefit for the wealthy. I would say not really. I mean, a lot of, blue collar workers are buying equipment, trucks. Now, some people are buying airplanes and doing the same thing with it. There's definitely use. It needs to be a business use.
Yep.
And, if you buy an airplane and decide to fly down to the Bahamas once a month, then, they're not going to allow you to accelerate it at 100%. And, I say that, kind of jokingly, but, there's actually a company that just got dinged for it. They had like a $25 million acquisition of an airplane, but they were taking trips down to the Bahamas. And the IRS said, you know what? If it was only business use, sure. But that's not what was going on. So, it's really documenting everything. And I would also say that, because we already talked about it, as
Mm.
guys, if you are operating Airbnbs, document your time. Make sure that you can prove that you are materially participating in managing that property if you're trying to qualify for that short-term rental loophole. Really dot your I's and cross your T's. So
Definitely, definitely. Thanks. Good reinforcement there to make sure that you have your logging done. Got to show that paper trail. So I've heard some drawbacks, up and coming, learning stuff about cost seg and just being in this space of trying to absorb as much as possible, right? Of well, cost seg has so many benefits, but there could be some negatives as well. It's usually comes in the form of you can do that, but watch out for this, or you should really consider this. And it's really part of strategy, right? With what you were talking about, making sure your CPA is involved, making sure your attorney's involved, and really having people involved that are part of that team to make sure that there is a strategy in place. So, kind of that in mind, what could some of the drawbacks be, and what is a scenario where they would actually come into fruition?
yeah, so there's a couple of drawbacks. So the first one is the depreciation recapture. So you would not want to do a cost segregation study on a property that you're planning on selling within the next couple of years, unless your CPA is telling you to, because it's part of an overall strategy. Uh, because the depreciation recapture on personal property is taxed at ordinary income rates. So all of a sudden, your short life asset, so let's say that appliance, that refrigerator, if you have any gain on that asset, then the depreciation recapture would be at ordinary income rates. So there's workarounds on that, because that refrigerator or that truck or computer or whatever it is depreciating at the same time, meaning the fair market value of that asset is not the same as it was when you initially acquired the property. So there's workarounds there, but it is something to take into consideration. That would be the first one. The next one is, you really want to make sure that if you are involved in, let's say, a syndication, and the clients are doing a cost segregation study, or the owners are doing a cost segregation study on it, they're just not trying to front load all that depreciation for the early investors or the early owners, because the guys that are coming in and buying into that syndication in year, let's say 3 or 4, if they're getting swapped out, you want to make sure that they're still benefiting from owning that asset. So, while you want to be, I don't want to say aggressive, let's say you want to have the accurate allocations in the cost segregation study, you want to make sure it really supports, again, the long-term goals of that entity. So that's something to take into consideration. Another one is, make sure that you have a conversation with your cost segregation provider. There are DIY services where you can go online and generate a DIY study. But if you're involved in an audit in 3 years, or if you have questions on that study today, can you actually pick up the phone and get someone on the line and have that conversation? So that's one of the tenets, if you will. I try to beat it into my team's head every Wednesday on our meeting is, really we're providing, first of all, it's tax savings to our clients. We're trying to provide accurate data and personalized service. And I think in today's world, with automation, you can automate emails to death and newsletters and everything else. But I tell you, man, you really want to make sure that you can pick up the phone and call somebody, or if you do email them, that it's not a canned bot responding back.
Hmm.
So
Hmm.
personalized service. So make sure just that you can talk to the individual provider. And the reason for that as well is, maybe you don't want them to be that aggressive. Maybe if you're okay with taking kind of the bare minimum, and you don't want to push the limits of what you're accelerating. So that's another piece.
Got it. So, uh, I think you dropped a lot of nuggets there. One thing I wanted to go back to, and maybe we could, as an example, and if there's one rule I really try to avoid, it's doing math on the fly. But if we could, if we could do, I know, holding up the smartphone, I like that, but
Calculator.
calculate, uh, but of course, handy for you, definitely. Um, but maybe go with me on this just so that we can um, provide some quick numbers to this, right? As an example, my audience loves numbers. They want to, they're hearing what you're saying. Brian, this sounds good, and I'm getting this. But you were talking about we're talking about this theme of drawbacks and talking about how be careful about that recapture and what this could ultimately mean. Let me just pose this question, and you can help correct it and add on. Are you then saying um, that if you go and have a property and you do a cost seg study on it, you pull all of this depreciation forward, right? If you were to sell that, the sell becomes, well, it's a taxable event, right? It's on the sale of this property. So would you then have to pay additional taxes for all of that depreciation that you paid forward, which could be more than if you did not do that study? Is that what you're saying?
It just depends on the way you structure the disposition of the asset. So uh, that is a bigger question, that when you sell the property, and I would say before anybody ever sells an investment, they really need to sit down with their financial advisor, their CPA, and really unpack it before the sale goes through, because it is going to be a taxable event. Um, and you just want to make sure you're prepared for that taxable event, and make sure that you're doing it at the appropriate time. Because maybe this year isn't the best year to sell it, because I have sold all these other properties.
Totally.
So you just have to really plan it out. So it's not one fit or one, what is it?
One size fits all.
Well, I was going to say, what is it? A simple question, complicated answer.
Sure, sure,
So
sure,
yeah.
sure. Got it. Great. Okay, cool. So in a case where there wasn't a good strategy to reduce those reduce taxes on that event, objectively pulling for doing a cost seg study could mean more taxes could be paid, but you just each individual has to consider their own tax scenario on how to reduce their taxes?
Uh, yes and no. It depends on the sale of the asset as well. Some contracts will bake in allocations. I'm not a fan of purchase price allocations on commercial properties, but certainly if the personal property that was in that building at the sale, the value of it, the fair market value is basically zero, then you wouldn't have any additional taxable event. So it really just depends on the sale. So it's again, it's not just something I can answer across the
Sure.
board.
Totally,
So
totally. I know there's
not
totally
necessarily is the answer. So,
got it. But
but
things to look
potentially,
out
yeah,
for. Things to look out for, and each person needs to go and ask those questions about.
yeah, I would at the time that you sell the property, whether it's 5 years or 10 years. How's this sale going to impact me?
Cool, got it. So talk to me a little about, you talked about, types of things that your team and your company does, Cost Seg. These are you obviously have expertise in this you've been doing. You have certain types of niches that you serve clients for. I mean, kind of a big world, but is there certain things that you are
I'll
you
take a look at
specifically?
a property. And again, anytime a client comes to me, I just say, go to the website, CostSegRx.com,
Mhm.
ask for an estimate of benefit, and I'll take a look at the property and I'll work up the estimate if it's within my scope of work. Um, Not all cost segregation providers, are equal in the sense that, there's very large companies. Think about, the big four accounting firms. Um, and they may be doing cost segregation studies on casinos in Las Vegas that cost billions of dollars to build.
Mhm.
Just that's the reality.
Yeah.
So, or they're doing cost segregation studies on chip manufacturing plants. So that would be outside of my scope of work. I don't have the expertise. So my engineers would, just look at me.
What's going on, dude?
So I would refer them out to somebody else. But I mean, for the most part, the most of the buildings that I get are, residential. They're Airbnbs. They're mixed use industrial. There's car washes, doctors' offices, veterinarian clinics.
Cool.
I mean, we can basically, because what we're doing is we're going in and we're doing a construction cost estimate. We're rebuilding that property using national construction cost data. And then we're applying depreciation of the different components within that
Mhm.
building, or I should say units of property within that building. So if it's a property that I'm comfortable that I could rebuild, then I'd absolutely work up the estimate and see what we could do. So I'd say it's a full, it's fun. I mean, I really do like some of these projects that I see. RV parks are always really cool to do. I get investors that buy them across the United States, and whether I do the physical site inspection myself or I have a third party do it, it's neat to see what they're doing, putting in, little, you've got your RV spots, but then they'll put in these tiny home builds.
Yep.
They'll add swimming pools. So
Mhm.
all of that stuff is, it's kind of, it's fun to build. So,
Yeah.
or to build on paper, I should say.
Yeah, yeah. There's it's going from just the property to, service and then experiences and, all kinds of stuff on them, certainly.
Yeah.
Um, Especially ones properties that, it's not just a property, but there's multiple businesses or revenue streams on there too with different assets, right?
hmm Yeah, the other thing, when it comes to these clients or these syndications that are buying these different assets, make sure you're documenting all of your improvements to the property. A lot of clients they'll expense it. Like, "Oh, I remodeled my kitchen. It cost $35,000. I expensed it the year that I, incurred the
Mhm.
capital expenditure." Really, those items need to be capitalized. And if it's a commercial property, it'll qualify for QIP. So qualified improvement property, and you're treating it correctly on your fixed asset schedule. So you can accelerate that. It's a 15-year tax life, and it's eligible for bonus depreciation. So just really track all your improvements.
So is it that you mentioned something about, if that you could do this at a national level too? Not, you and your team, it's something you could do local. You could either fly out, have someone from your team fly out, or you'd work with a third party. So you can offer this service across the nation then?
Yeah, so it's interesting when I first got started doing it, I was working with a company out of San Diego, and I'm here in Sarasota, Florida. And what was cool about that is I ended up meeting investors all across the country. So yeah, we can do studies all across the country. If it's a larger commercial property, typically I'll fly out there myself to do the site inspection. If it's smaller commercial or residential, typically I'll hire a third party to do a site inspection for me. So yeah, we can do them all across the country.
Okay.
And different properties, for the most part, mixed use industrial properties are pretty much all the same. You still want to do a walk of the interior to see what type of improvements they've made. Did they build out, a break room? What does the computer connections look like? What's the security look
Mhm.
like in the building? Those are the items that we're looking for. Just the build outs.
Got it. How long does something like this take for some of these different asset classes you were talking about?
So it depends on the scope of work. Realistically, it only takes I always tell clients, we'll deliver the studies within 2 to 3 weeks after the site inspection or after you decide to move forward with the study. If you need it faster, just let me know and I could bump it up in line. Really, the biggest holdup that we have is just pipeline. So a
It's a good
lot of
problem.
people are a lot of people are procrastinators, so we tend to get busy right before taxes are due in September and April, and then again right before, or did I say September? Yeah, I did.
Yeah, you did.
Sorry. Yeah. We could beep that out. So yeah, but it was what is it, February and April, and then again in September and October. So we have that first push right at the beginning of the year, and then we have the second push right before taxes are due. So we just came through our slow period in June. We're
Mhm.
going to get really busy again in July and August for corporations trying to file in September, and then
Yes.
your individuals that are filing in October.
Right.
So what I advise clients to do is just put it on your checklist, your standard operating procedure. As soon as you close escrow on that property, get an estimate on the cost segregation study and move forward as soon as possible. That way you're not up against deadlines, because it just, especially if we've got to fly up there and do the site inspection. If you bought I don't know, think about a garden style hotel that has, built out resort style swimming pools and tennis courts. You have to go walk it and really look at all the assets. So, that's not something that you're just going to do in a week.
Yeah.
So,
Is
you
it
know,
is it ever too late to do a cost seg study on
Yeah,
a
so
property?
it is. So there's a couple of things. So you can actually go back years. So if you didn't do a cost segregation study on a property that you acquired years ago, we can still go back and do a look back study. You don't have to amend your tax returns. The IRS allows you to use document 3115, a change of accounting method, and pull forward the 481A adjustments or your missed depreciation. So you can go back in time and do it. I would say you probably don't want to go too far back in time. Like if a client came to me and said, I bought a property back in 2002, could I do a cost segregation study? You've already taken most of the depreciation, unless, of course, they did a major remodel a couple of years ago and they want to do that. Then I'd say,
Did
yeah,
some
let's go ahead and look
improvements.
at it. Uh, I would say that if you're doing a look back study, though, in order to use the form 3115, it has to be with a timely filed tax return. So you can't come and say, hey, I'm going to do a look back study and then try to do it in November. That's not going to work because it's not
Mhm.
timely filed. So eh, you
Wait
can
till the
go
next
back
year
and do
kinda
it. You
thing.
just have to follow the IRS guidelines. So
And I imagine just like everything, if for those particular, situations for whoever's listening, those are the kind of things wanna reach out and ask about.
yeah, definitely reach out, ask, and I didn't give my disclosure ahead of time, but you know, this is just for informational purposes. Everybody's scenario is a little bit different. Talk to your CPA, talk to your financial advisor, make sure cost segregation fits into you know, your overall
Yeah, I was definitely gonna
horizon.
make sure to put that at the very start of this, at the very trailer. Like, anything you hear from now, it's just for educational
Oh,
purposes.
and the other thing, that's very real is things change all the time. So,
Mhm.
we're recording this, when is it? June of 2025.
Yep.
If you're listening to this at a future date,
Thanks for the
You're going to
good
have
one.
to get refreshed because things change all the time.
Yeah, yeah, that's definitely common for the listeners in the tech space. I can't tell you how much things are changing,
Oh,
especially with AI.
I'm AI is one of those things that I'm just hooked on, and I'll tell you, it is amazing how fast things are changing. It seems like I don't know, every week there's another major update, and it just blows my mind. So
So, uh, l let's talk about this. I know we're coming up on in time we had scheduled for this, but if you got a couple more minutes, I'd love to ask you,
yeah, go ahead.
how has, tech been changing this, business for you?
So great question. I think with AI specifically, what it's going to allow us to do as an industry, and probably most industries, it's going to allow us to do a lot more work with more accuracy. So my engineers are going to be able, instead of taking them 10 hours to build out a file, they'll be able to have AI build it out in 15 minutes, and then they'll be able to review it over the next 2 or 3 hours and make corrections. So that's how it's currently impacting, or I see it impacting,
Mhm.
cost segregation, accounting, coding, everything. So the reality though that I see is, you talk about AI agents, or there's a lot of talk of the AI agent.
Yep.
It's great, but you're still going to have someone that has their hands on the steering wheel or close to the steering wheel, just because it's little errors like, maybe they're talking about units and versus linear feet. So, in my world, if you're doing construction cost estimating, and maybe it's a cubic foot versus a cubic yard, we see these little input errors sometimes. And the AI will even be able to pick up the mistakes that it's making, but it doesn't always seem to be able to correct them. So
Got
maybe
it.
maybe next week that will be fixed, but that's the problem that I'm seeing today. We still have to have someone, look at this.
Yeah, that's it's cool here because the follow up question there is there and I'll just state it bluntly, is there how much concern is there about technology and AI coming in and taking jobs and things like that? And um I fully hear you when you were talking about like you want to whoever's doing cost seg studies want to make sure that there are a phone number, something, whatever, right, a way to contact someone and get that strategy, that advisement, and so forth. That's always going to be there. And like you just said, tech will allow you to do things twice as fast, 10 times as fast, more business, and get through some of these things whilst having someone still at the quote unquote steering wheel or running the project.
Hmm.
Um but is there some of that concern in industry as well for you too?
Not for me. I mean, I guess because I'm the owner of the company, maybe I'm a little naive too. I do know that it is going to impact us, and my eyes are wide open. I tell my team that their jobs are at risk unless they know how to use the tools that are available to them. And I think that no matter what industry and you're in currently, is you really have to understand that these tools are powerful, and just learn how to use them. So I think that if you're not paying attention to it, then yeah, you're going to be out of a job. But if you understand how to write prompts, you understand how to work with an agent to make your day-to-day KPIs, you blow them out of the water all of a sudden.
Hmm.
Yeah, so I'm not so concerned about it as long as you're paying attention to it.
Awesome. I'm of the same mind here. Obviously, it's you've seen tech change a lot, and if it wasn't AI now, it was automation before, et cetera, et cetera. Got to do better. I love your frame of mind on this. That you just have to keep on using these tools and get better with them. You stay pretty informed with this. You're talking about agents and agentic AI, pretty much. Is this really top of mind for you to look at what new tools we can bring into your business to make you go faster, help serve customers more, et cetera?
Absolutely. Yeah. I mean, at the end of the day, I think, it's going to, I mean, I don't want to say it's a race to the bottom on pricing. I don't think that's going to happen, but I think it's going to open up the doors to cost segregation to a lot more people. We've already seen that over the years where you couldn't do a study for under several $1,000s. You used to get quotes for $10,000 on a small hotel. That's,
Hmm.
that just shouldn't be the pricing anymore. And it's because technology has improved so much. Now I can literally look at a database of over 92,000 items and build out an entire property within, a couple of, days. Um, Working with an AI tool that can now, read the blueprints.
Yep.
So and then
Yep.
plug in the data. I think it's gonna allow us to do a lot more work, and I think it's gonna make it a lot more affordable just the industry. So I think what it's gonna do is we're gonna see a lot more work. So
Do you
we're gonna be
consider
busier.
do you consider your company to be a tech company at this point?
No. I mean, I count light bulbs for a living. That's what I tell my wife. I'm looking at light bulbs all day long. I'm literally measuring driveways, so tech company, no. And it's nice too because I don't have to wear a suit and tie. I don't, fly out and meet a client. I go to Lowe's and I bought a Lowe's vest
Yeah,
just
yeah,
so I
yeah.
look like a construction worker. I tell the guys, look, I'm not a health inspector if I'm, doing a site inspection on a restaurant, and I'm not a county inspector if I'm looking at commercial property.
Yeah.
But that's yeah, I would say it's still low tech, but we are absolutely looking at all the tools that are out there um, to make sure that we're able to improve and get better and better every day. Yeah.
Yeah. How last question for me, and we'll do our closeout. How are you staying up to date with the tech like this?
I would say the same way everybody is nowadays, YouTube. Yeah. So what's really interesting, and if clients are, if anybody's watching this, I mean, well, probably not this video, but so many videos on YouTube, what you really need to do is hit pause and look at all the tools they have open in their browser and
Yeah.
just take notes on all those tools, because then all of a sudden you're looking at, oh, well, if I want to do a thumbnail for YouTube, I'll just use Glyph, and it's like,
Yeah.
it's, yeah. So just hit pause and look at those, the thumbnails that are open on people's browsers. And I think that's the deep dive.
Yeah. Yeah, and if anyone's listening to this from the tech space, that is a security risk. Make sure you have all of your tabs closed because Brian's looking.
Absolutely. Yeah, and if you're in a conference sitting in front of me, don't be on your laptop. I'm just saying, it's the dumbest thing I've ever seen.
Brian, super stoked to have you on, dude. You mentioned it a couple times before, but mentioned again here. Where can people go to find out more about you? Who is the right people, the people that you love to work with, and
Yeah, I would say anybody that's looking or interested in a cost segregation study, just go to CostSegRx.com, and my phone number is there. You can schedule a call. You can just click a button to get an estimate of benefit. Uh, and that's it. Just jump on the line. Estimates of benefit are the best way to go, because then you can take it back to your CPA, make sure it fits your strategy. And if you want to move forward, great. It's certainly not a not high sales at all, meaning I've got clients that'll get an estimate and they won't move forward for a year. I understand it. It's kind of one of these things that's just in time. As soon as you need it, you're ready to move forward. So CostSegRx.com.
awesome. You also got a podcast. I saw that we were talking about the head before we start recording. Check that out for Brian's stuff as well. And what I just really want to emphasize too, like what you're talking about, is go and get the study done. Go learn more about it so that when you do need it, you're not waiting at the last second for your own tax returns. You're informed and get ahead of that kind of stuff. So, dude, loved having you on. Loved chatting with you, Brian. I do look forward to having you on again. I'm sure there'll be more questions.
We'll
So,
have updates in a couple of months. So yeah.
okay, we'll have you back on, dude. Appreciate you.
Thanks.
Thank you, sir. Thanks for joining us on another episode of Path to Passive. We love connecting with our listeners and those on the path to architecting their wealth and improving their lives. Feel free to let us know what topics you'd like to see in future episodes. Get in touch with us through email or Instagram. See you next week for a new episode.